Hey guys, AKIL'S here. Welcome back to another video. Today we're going to talk about some common stop loss and target taking mistakes that many traders make. We're going to share this lesson in the form of a technical breakdown as we walk you through the before and after of a trading opportunity. And we're going to talk about a lot of things: 3-bar reversals, inside bars, structured trading, the IPDE, identify, predict, decide, execute process, different techniques for stop losses, the average true range, risk reward, how to pick targets, Keltner channels, and the downside of trying to force a trade. So take your notebook out, give it a listen. Also, we have another online trading workshop coming on May 29th. Link is in the description box below. Make sure you sign up. That way you can register. Seats are limited. Oh yeah, and hit that like button. Do it now before you forget. Okay, let's hop in. Look at the dollar yen here. This is an interesting trade setup that I like, but wasn't able to get involved. I have another one like that on pound yen that I like, but can't get involved in. But I want to talk about them anyway, because I know some of you guys might want to get involved. And let's kind of break it down as we always do from the higher time frames using our IPDE process, and we will get going. So let's go through that boring 4-step process: identify, predict, decide, execute. Sorry about that, I fell asleep. And let's ask ourselves, what is price doing? What has price recently done? So dollar yen, what are we doing here? If I zoom out my chart, bullish, bearish, consolidation. As far as, I guess you could say, long-term trend, I plan on doing a podcast episode later today on Dow theory. So we're going to talk a little bit about long-term trends, short-term trends, and kind of the noise in between. But safe to say we're in a little bit of consolidation. We're just kind of going sideways. Again, don't overcomplicate this. Just like we teach in the workshops, if price action is going from left to right, it's consolidation. If it's going from bottom left to top right, uptrend, top left, bottom right, downtrend, side to side, consolidation. So we're in a period of consolidation. So we're just doing the bouncy bounce from one point to another, right? And in situations like these, you guys know I like to trade from structure to structure. I like to trade from structure to structure regardless, but especially in consolidative period, this is where the counter trend trading juices start to flow, and I start looking for structure to structure. So we understand that we're in consolidation. What has price action recently done? Where have we come to? And this is where it gets a little bit tricky, and this is where you got to pay attention to details. Specifically talking about this move. Who can tell me what this move has done? Who done it? What has it done? What did it do? Ah, yes. Fitzy says break above, close above. A baka. You look at this You look at this like shortly, you glance at it, you want to say that it came to previous structure and held, right? Because it looks like that it came to previous structure, we start working our way back down. But if you look closely, right, you zoom in, you'll see that we actually put it in a break above, close above, right? As Fitzy said, a baka, right? That's weird to say, but I like it, Fitzy. So we know we have a break above, close above. We expect what? A continuation higher. We know that markets like to breathe. So we just don't always continuate higher right away. Sometimes we go lower. And if we go lower, where do we expect price action to go lower to? Previous levels of structure before working a little bit higher. So we could be in a situation right here where we have a pullback for a potential move higher. Now, this is difficult because higher we have another level of structure. So this is why it's not like a full-blown trend continuation where you're looking for price to rally to 156s. But you're probably saying to yourself, yeah, we can go to 150, nice psychological number. If I just drew a line or draw a line out here, I'm stuck between present tense and past tense. At 150, you can see that we have a nice little spike and rejection zone right here. So that could be a pretty decent level, right? So we're setting up kind of our idea here. We go down to the 4-hour time frame, right? And we get a little clearer picture of that, right? And this is the one, if you guys remember yesterday, where we don't have a break and close above, right? This is the double top we looked at, or not the double top, the potential double top we looked at yesterday, where we were kind of fighting in between break and close above on one time frame, not breaking close above amongst another time frame. And again, this is the reason why this is a trade that I like, but I can't actually take, but want to talk about. So with that in mind, right, we've actually come down from that double top area that we spoke about yesterday, double top that never actually formed, that we spoke about yesterday. And we came down right to the target area in which we are looking at, right? You guys remember identifying this level, the consolidation level right before the elephant candle, the inside structure looking left? Yeah, look at that. We came right down to that level and boom, we're getting rejected. Surprise, surprise, right? And we go one more time frame lower to the hourly, and we have put in a beautiful, who can tell me what this setup is called? Boom, boom, bang. Actually, I'll take two answers for this. One, a 3-bar reversal, right? High momentum candle going down to the downside, nice little rejection, bow. Doji candle in the middle, indecision, markets having to think. And then a confirmation candle in the higher high, higher close, right? What else? What else is this? Specifically that middle bar. What else is that called? We've spoken about it from time to time. There's a nice indicator you can use as well. It is an indecision, that is correct. An inside bar was the answer I was looking for, right? An inside bar, right? So a bar that completes, completely inside of the previous bar. And that offers its own little kind of breakout strategy as well, called an inside bar break, which this candle actually gives us. And if you're using an inside bar break strategy, you'd be involved a little bit higher. So really, really, really cool ways to get involved, right? So what's the problem here? Well, the problem is, well, for me at least, I don't know what the problem is for you. Or if there's not a problem for you, I think this is a good trade. But what do we need to know now about the trade? We have our entries. If we're looking for an entry for our trade, we have our entries. We need to know two other things. We need to know stops. We need to know targets, right? So give me an idea for stop losses. How do you guys like to put stops? You know how I like to put stops, and many of you guys do it the same way as me. But let's talk about stops, and you're going to start to see where a little bit of the drama comes in, I guess you can say. So Chris says 1 ATR below. So our ATR should be 38, if I remember correctly. And let me just double check this. Actually, we have a new candle, so it might be a little bit different. It is 28, right? No, sorry, looking at the wrong thing. I'm looking at RSI. Yeah, it's 36, right? Our lows here are going to be 145.60. So 60 minus 36 is 24. So a 1 ATR stop loss would be right down here at 24. It was 22 earlier. Now it's at 24, so it got a little bit smaller, right? 24, right? And I'll label this 1 ATR stop loss. Now, what do you guys think about this stop loss? 1 times ATR stop loss. We know that our stop loss is supposed to put us in a place where we feel safe, a place where we believe that if we are right, the market is not likely to go to, a place that hopefully provides us some type of protection. And Fitzy says, it doesn't look safe. Carlos says, it looks dangerous. Sean says, we're still in the danger zone, right? Hence where you see the problem, right? You can look at this, and I'm glad you guys didn't see this. You can look at this gapage right here and maybe get confused that this is a level of structure, but it is not, right? This gap just represents, I was speaking to another trader about trading gap, or had a question about on YouTube about trading gaps. And I said, the way I look at gaps is basically I just fill in the blank with a candle. Some platforms will actually do it for you. But I look at this and we closed right here. We opened right here. All that means is that there is a green candle right there. Does that make sense? Excuse me, with gaps. So this isn't an actual important level of structure. The level of structure that is going to be important is going to be down here, and we are not beyond that. Now, this goes hand in hand with the lesson that we put in yesterday, right? Well, remember yesterday I told you guys about flexibility in our trading rules, and how one of the rules that I became flexible with was my stop loss and using a 1 to 2 ATR range. Let's see what a 2 ATR range would give us. Let's take another 30, was it 32 now? Ooh, forgetting, 36, 32? 36 away from here. This is 26 minus 36 is going to be 90s. Let's see where 90s puts us. 144 90s. Does 144 90s put us at a safe level? So the first one is our 1 ATR stop. The second one is our 2 ATR stop. Fitzy says not quite. Ah, dang it. Right? So either way we look at it, my stop loss is not in an area in which I feel comfortable. And we're gonna get back to that in a little bit. Now, here's another interesting one. And this one's going to be a little bit more dynamic depending on the type of trader you are. Let's talk targets. Target taking. Where would you guys be interested in? You can give me first targets, secondary targets, thirdary targets. I don't know how to say that word. Targets were a little bit confusing for me as well. I had two levels that I liked. Chris says 146.85. So shoot them in. I'll draw them up for you. 146.85. Looking at this inside level of structure right there, right? Some of you guys are probably going to identify the same level. So let's just do this, right? This zone right here, right? I think that is the most, if you're looking for the most conservative target ever, that is the safest place. Sean says 106.15. So let's, I'm going to steal this. Give me that. There we go. Let's get you back down here. There we go. I love when I talk to the charts. 147.15. Okay, that's still in that area. Another one I would say is right here I had on my radar, a little bit higher, about 147.55. I don't know if you guys can see this. It's right. It's this ice zone, right? Which we talked about yesterday. It's this ice zone right here between previous, come on, arrow. It's previous lows, support, right? Support and then resistance. But what I did was I shifted it down some because I take the highest closes. That's another conservative level I had on my radar. And then the extreme levels were the easy ones. These were the top of structure and then the higher level of structure that we identified on the daily. But we know that when we're doing our initial risk reward, it's based off the lower levels. So another question that we have here is, am I going to get a quality risk reward? If I enter right on the higher high, higher close of this 3-bar reversal, and if I have my stop loss even at the most conservative one ATR right there, if I'm aiming for the bottom of this zone, negative risk reward. If I'm aiming for 147 even, negative risk reward, psychological number. If I'm aiming for 147.15s, just getting it minus the spread, right? So it's also very difficult to get a one-to-one risk reward with this situation. So hence why this was a trading setup that I liked, but not necessarily one that I was able to trade because the whole picture didn't fit together. Real quick, I forgot if this was this one or pound yen. We had the Keltner channel too. Yeah, this one, another one for you guys that remember the Keltner channel deal we were doing. See how we're below the band as well? So this would be a good example of the DKC. We've broken and closed below the volatility band. We put in a nice 3-bar reversal. We should revert to the mean. I don't use the moving average, the middle moving average for, I don't have it on here, but that would be right here. We should revert to that middle moving average, which is in a color that you guys cannot really see, pink. But that could be another clue that you can add to the puzzle for you guys that like using these volatility bands as well. So here is the problem that traders get into. Right? They see this, they get all excited. Ooh, 3-bar reversal. Ooh, this, ooh, that. And then they do the rest of the stuff like, man, 1 ATR stop loss is not good. And they try to make it work, right? And one mistake that I see that traders do when they try to, quote unquote, make it work is, one, they will just take a stop loss because it's there, right? They will ignore that the stop loss should be in a place that makes them feel safe, a place that allows them to be protected. They will just say, I'm going to put my stop loss there because it works, right? And that is a big no-no. What is the other thing you think traders do? What if I'm a trader that said this? Okay, well, I'm going to have my stop loss lower to protect myself. But man, now my risk reward is way out of whack. It's a negative risk reward. Huh. Well, how do I fix a negative risk reward? Well, Forced target, says Fitzy, right? So I say, you know what? I'm just going to take targets. I need a 1.5, right? I'm going to take targets here because this gives me the risk reward. They fall, and it pisses me off when I see this, but traders fall so in love with the risk reward that they forget the fact that a risk reward means nothing if you're not good at projecting the target, right? It's like it's like Americans would of course use a gun reference, but it's like choosing a very big weapon, but you don't have the ability to use that weapon or something like that. It's a bad analogy, but you guys get what I'm saying. They're picking a level that they don't actually think price will go to, but they're picking that level simply because it's an excuse for them to be into the trade. And then all of a sudden, you get into the point where now you're trading something and price may go in your direction, but it doesn't hit your target because your target's in a dumb location. And it just defeats the purpose because you eventually get stopped out. So that's a no-no as well. So you don't want to force these things. If it doesn't work, it doesn't work. There will be many of trading opportunities to come. One thing you can do, especially if you're someone that has secondary reasons for entry, you can look for secondary reasons. You can say, hey, I can't take this 3-bar reversal, but I can take a double bottom or a 2618, something like that. And you can wait for an alternative reason for entry. Or this is something you study in the future. You review it, you walk through it, you make it your perfect trade, you take notes, and then you put it somewhere in a folder to be reviewed later. And maybe at some point in time, you find a way that you can aggressively or you can find a way that you can involve yourself in this trade, as you gain experience. So I like the idea. I think we're going to go long. I think the same thing with pound yen. Pound yen's another one. It just doesn't meet the profile. And that is the true, people will make fun of me and make fun of you. Where it's like, well, how can you make a prediction for a good trade and not take it? And here's the thing. That is trading. That is trading. Real trading means the ability to find something that you like, that you think will work, that you feel good about, but have the discipline not to trade it. That sounds like a t-shirt. Oh man, someone make that a t-shirt. Dollar yen was actually one that worked out. Look at that. If you took the initial target level, remember we spoke about this zone? I'll tell you what, you deserve this, guys. Hats off to you. I want you to tap yourself on the back because, right, we didn't delete this analysis. And this box here was when I asked you guys, what do you guys think about targets? And I shared with you my targets and whatever like that. We're all in that same area. Look what the market did, right? Did it not go right to that area? Tickle it ever so gently and then reverse? That's a great job of projecting targets. That's a great job. The market literally went to where you thought it would go. And it did not go further. It's going to sound weird, but that's the best prediction you can make. Because that means we talk about maximum favorable excursion, right? That means you pretty much, so there's 3 ways predictions can go. Working in the rule of threes because humans like threes. 1, you make a prediction to go higher to X level. And then the market goes against you. It never even sniffs in that direction. The floor crumbles from underneath it and it tanks down. So guess what you made? That's a bad prediction. The process could be good. The market does whatever the F it wants, right? We know that. But that's a bad prediction. Price obviously didn't even have a think. It didn't do anything that you thought it would do. It just went against you. Bad prediction. 2, you make a prediction, 147 even. Price blows straight up through it. Big green candle. There's no news or anything like that. It goes all the way up to 150, right? Now you're looking at yourself and you're saying, okay, yeah, that would have hit targets. But what else did it do? Yes, it would have hit your targets. You would have made some money, baby, right? But you also left a lot on the table, did you not? And this is where some traders beat themselves up, where it's like, man, Akil, I didn't get every penny of the move, right? So it's a decent prediction, But why did market go further up? There's a lot more to be had. This is, I think, the best prediction you can make. And it's going to sound weird because everyone's like, well, the bigger prediction should be the better one. No. From a prediction perspective, this is the best prediction you can make. You know why? Because if you were in this trade, you maximized how much you made versus how much the market was willing to give. So if we're looking at maximum favorable excursion, which is the most you can get out of a trade before you overshoot it and get greedy. If you look at like a ratio between how much you made of the trade versus how much was able to be made, right? This has to be what? Let's take a look at this. If we're looking at this and the higher high, higher close was our entry right here, or the double top was our double bottom was our entry. Let's do the higher high, higher close right here aggressively, right? And we're looking for 146.97, right? Because the Akil likes his sevens, right? 146.97. That is 80 pips, right? The highest this trade went to, our maximum favorable excursion, was 94 pips. I'm going to do some quick math for you guys. In my head, unless my calculator app shows up on the wrong screen and you catch me lying, in my head, now I forgot the first number. Shoot, what was that first number, guys? Was it 86? 96 was the high, right? I forgot already. 93. All right, we're going to say 80. 80 divided by 93. You captured 86%. I mean, let me do some math. Divided by 3. Put the number on top of the house. Ooh. You captured 86% of the available profit. How about that? That's damn good. As Fitzy said, that's the Goldilocks prediction, right? So take a lot of pride in that. It seems weird. It seems weird, but that's one of the things that I've worked on in my trading because I'm very conservative, as you guys know, and I would often shoot for like targets at a certain level, and then price would go up here. And again, it looks good because you're like, yeah, I picked the trade entry, and the market blew up like 500 pips from where I was at. And I remember my mentor asking me, he's like, well, how much did you get out of it? I'm like 20. He's like, so you got less than 10% of the trade. I said, yeah, but it went up 500 pips. He's like, well, what's the point if you didn't capture any of it? I'm like, likes on Twitter, post-trade likes on Twitter. He said, and how does that help your account? Makes me feel good. He said, do feels pay the bills? I said, no. No, they don't, Todd. No, they don't. Right? So gotta change I was never that shallow. I never cared about likes. That's just a story I'm doing. I can care less about likes and stuff on whatever it is, social media, unless we're referring to my podcast. And please like and subscribe and rate and review and all that fun stuff, right? But yeah, so it got me on this goal of and it comes with a lot of reviews, a lot of playing in the sandbox, a lot of journaling, right? But how can I maximize my average return? That's actually something I should start tracking again. Your average percentage return versus, again, maximum favorable excursion, what you captured, the percentage of what you captured versus what the market was willing to give. That would be a pretty fun number to see. I bet I would be up there. There's some other factors that would have to play a role in there that would make it confusing, but that's not a bad number to track. Anyway, good job. You did good. The market, you took almost everything the market was willing to give. So if this were a robbery, you cleaned that house out. Well done. And you didn't get caught.
I wanna be the best in the game, invest in my name, check no restraints, I'm obsessed with the pain, I ingest, I retain, assess and I change, possessed by the thought I'll be free one day from society's restraints, money, clout and fame, mud, disease, a plague, we all love to hate, have to play the game, have to make a name, all our insecurities are on display.